Welcome, dear students, to the massive open online course on money and financial markets. In today's module, we are going to discuss about security analysis. Basically, this is going to be a first part of security analysis. The main objective of today's course is to explain the notion of risk and also to explore the various types of risks. The value of financial assets depends, among other things, on their return and risk. And for a good understanding of the financial system, it is really necessary to know certain basics of security analysis. Before we venture into understanding what risk necessarily is, we need to understand three main concepts. One is what is certainty, what is uncertainty, and then we go to the concept of risk. Certainty is a situation wherein the value the variable can take is known with a probability of unity, while uncertainty is a situation where the objective probability distribution of the values are not known. Risk is a situation wherein the objective probability distribution of values a variable can take are known. Now, what is objective probability distribution? Now, the objective probability is one which is supported by rigorous theory, past experiences and laws of chance. While risk is measurable, uncertainty is not. Since a situation of uncertainty can be reduced to a situation of risk by using subjective probabilities, the two terms risk and uncertainty will be used interchangeably in this module. Now, risk can be defined as a chance that the expected advantage, gain, profit or return may not materialize and that the actual outcome of the investment may be less than the expected outcome. The greater the variability or dispersion in the possible outcomes, or the broader the range of possible outcomes, the greater will be the risk. Usually, the variance and standard deviation of return serves as alternative measures of risk. Similarly, we will be using a term called covariance, which is going to measure the risk of the security relative to all other securities in the portfolio. Here, we need to remember one thing. When we say risk-free, it does not necessarily mean that only it is free from all risk. It does not necessarily mean so. It basically means that only the certainty of outcomes can be predicted and the expected variance being zero. Government bonds in this sense are risk-free in nominal terms, but they are not risk-free in real terms. We now come to the various types of risks that are prevalent in the market. The first and foremost is called systematic risk. It does not have a specific definition, but is an inherent risk existing in the stock market. In other words, it is a risk associated with the market as a whole. A consistent reaction will flow if an announcement or event impacts the entire stock market, and this is what a systematic risk is all about. This risk is going to apply to all the sectors, but of course it can be controlled. For example, if we take the government bonds, and for example, we say that a government bond offers a yield of around say 5% compared to the stock market, which provides a minimum return of say at least 10%. Suddenly, the government announces an additional tax burden of 1% on the stock market transactions. Obviously, this will be a systematic risk because it is going to impact all the stocks in the market and may make the government bonds more attractive. The next is unsystematic risk. Unsystematic risk in an industry or a firm-specific threat in each kind of investment. In other words, it is not related to the overall market variability. An investor can build a diversified portfolio, and in this way he can eliminate such type of risks. So, it is also known as specific risk or diversifiable risk, or sometimes it is also called residual risk. There are certain existing risks in the market which are unplanned and which can occur at any point, causing widespread disruptions. Okay? So, there are certain risks which are also called idiosyncratic risk. So, these risks are also called idiosyncratic risk, and it is specific to a company or to an individual. Example, say an airline industry. The staffs of the airline industry goes on an indefinite strike, and this will obviously cause the share of those airline industry to fall, and a fall in the price of the stocks is obviously going to impact this industry as a whole. Next, we turn to the concept of market risk, or basically it is measured by a coefficient called beta. So, what is a beta coefficient? It can measure the volatility of an individual stock compared to the systematic risk of the entire market. Basically, beta indicates the extent to which the risk of a given asset is non-diversifiable. You cannot diversify that risk. In statistical terms, beta basically represents the slope of the line through a regression of certain data points. So, in finance, each of these data points will represent an individual stock's return against those of the market as a whole. So, I will just be showing you in the next slide the pictures of how the beta is going to look like, and beta greater than 1 basically implies that it is more volatile. Now, how do we calculate beta? Beta is basically calculated as beta coefficient beta, as you can see in the slide, is equal to covariance of RE, RM. Now, what is RE? RE is the return on an individual stock, while RM is the return on the overall market, divided by the variance of RM, that is variance of the return on the overall market. Here we need to understand that covariance basically implies how changes in a stock's returns are related to changes in the return of the market, and variance refers to how far the market's data points spread out from their average value. So, this is how the beta coefficient is calculated. Now, I will be giving a very small example to explain this to you. Now, suppose you need to find the beta value compared with our stock exchange, that's Nifty. Now, based on the recent 5-year data, suppose a correlation between say a particular stock called ABC and Nifty is 0.5, the standard deviation of returns on the stock ABC is around 25.5% and Nifty is around 30.5%. So, in this case I can say that the beta value will be given by beta value of the stock ABC is basically 0.5 into 2.550 divided by 0.305, which is nothing but ultimately coming to 0.4180. So, here we find that the value of beta is basically less than 1. So, we can say that the share of the stock, particular stock ABC, would be less volatile as compared to the overall Nifty market. So, this is how we calculate beta. So, as you can see in this diagram, we have on the vertical axis, we have plotted the security return. On the horizontal axis, we have plotted the market return. And also you can see in this diagram, there are 3 lines. One is B. The line B where you can see we are having beta equal to 1. This is basically a 45-degree line. We have an upward sloping line A where beta is greater than 1 and another upward sloping line C which is indicating beta less than 1. Now, beta equal to 1, which is a 45-degree line, basically implies that for every 1% change in the market return on an average, the security return will also change by 1%. So, both the returns will be volatile to the same extent. That is what we mean by exactly beta equal to 1. But if you have seen in the previous diagram, I have shown another line which lies above beta equal to 1 line, that is line A, which shows beta greater than 1. This means that the security return is more volatile than the overall market return, and here beta value greater than 1 basically implies that they are performing better than the overall market. And these stocks basically are called high beta stocks and they can allow investors to earn substantial profits. However, such high beta stocks accompany a high risk factor also, with a possibility that the price can crash any time to average with the present market. In the diagram, we also saw another upward rising line which lies below the beta equal to 1 line. This line C means that the former is less volatile than the latter. So, beta values less than 1 with a stock will imply that they are performing lower or close to the overall market. These stocks are basically called low beta stocks, and they can allow investors to earn lower but steady returns. Such stocks basically comes with a very low risk factor, and they are considered stable against the overall volatility of the market. In the diagram, I have not shown any line where the beta value is equal to 0, but there are certain securities which do have beta value equal to 0. So, securities other than stocks have a beta value of 0 when compared to the stock market indices. And the most glaring example of this is gold, because gold is a security that may have a beta value of 0, signifying that its value may rise over time irrespective of how the stock market overall is performing. Investors can use beta equal to 0 type of assets to hedge against the stock market crash. That is why we know certain investors keep themselves invested in gold so that they can hedge themselves against any sort of stock market crash. After analyzing what exactly beta stocks are, let us look at the advantages of the beta stocks. Beta value of securities is one of the significant coefficients the investors analyze before they start investing. It basically helps investors to analyze the unsystematic or the market related risk related to a company, thereby indicating the level of interdependence between the two parameters. While risk averse individuals look for securities having a relatively low beta value, people looking to extract substantial capital gains from this sector often tend to invest in stocks of small and mid-cap companies demonstrating a high potential for growth. Alternatively, investors looking for stable securities to generate steady cash flow through dividend payments can invest in stocks having a beta value of 1. Though appealing, such shares are relatively expensive to procure. And if we look at the beta stocks, it also basically reflects or it demonstrates the past experience. Stock beta also reflects the past experience of a stock with respect to the performance of the stock market through a stipulated benchmark index. This helps potential investors to analyze the expected return on equity on the total amount pooled into such securities. But of course, the beta value of stocks also have its own limitations. The beta value of securities provides no indication of the systematic risk that is associated with such investment tools. In other words, the underlying performance of the issuing companies cannot be comprehended or understood fairly through such coefficient figures. As a result, investors sometimes run the risk of investing in value-trapped securities if they choose to pool their money based on the only beta in the share market. So, beta value of stocks is a vital tool investors should look into before investing in any stock market instrument. Though not an all-inclusive value, beta helps the investors to analyze the market risk associated with a stipulated instrument and its effect on the respective returns that are generated. Next, after analyzing all these risks, we come to another type of risk that is prevalent in the markets, and it is called interest rate risk. Now, interest rate risk is the potential for investment losses that can be triggered by a move upwards in the prevailing rates for new debt instruments. If interest rates rises, for instance, the value of bond or other fixed income investment in the secondary market will decline. The degree of rate risk is directly related to the length of time to maturity of the security. If the term is long, market value of the security may fluctuate widely. Okay? And here, in the context of interest rate risk, it can be divided into two broad types of risk called the price risk and the reinvestment risk. Next, we come to another very important concept of risk. It is called inflation risk. Inflation is a decline in the purchasing power of money over time, and failure to anticipate a change in inflation presents a risk that the realized return on an investment or the future value of an asset will be less than the expected value. Inflationary risk basically refers to the risk that inflation will undermine the performance of an investment, the value of an asset, or the purchasing power of a stream of income. Looking at the financial results without taking into account inflation is the nominal return. So, the value an investor would worry about is the purchasing power, referred to here as the real return. Any asset or income stream that is demonstrated in money is potentially vulnerable to inflationary risk because it will lose value in direct proportion to the decline in the purchasing power of money. Lending a fixed sum of money for later repayment is the classic example of an asset that is subject to inflationary risk, because the money that is repaid may be worth significantly less than the money that was lent out. Physical assets and equity are generally less sensitive to inflationary risk, and basically they also can benefit from unanticipated inflation in the market. Another important type of risk is exchange risk or currency risk. The exchange risk is caused by fluctuations in the investor's local currency as compared to the foreign investment currency. There is no exchange risk under the fixed exchange rate system, while the exchange risk is the highest under the freely floating exchange rate system. These risks can be mitigated through the use of a hedged exchange traded fund or by the individual investor using various investment instruments such as currency forwards or futures or options. Exchange rate risk is not completely avoidable, but yes, we can take steps to mitigate it. Next, we come to the concept of business risk. Business risk is any exposure a company or organization has to factors that may lower its profit or cause it to become bankrupt totally. The source of business risks are varied. They can be internal in nature or external in nature. They can range from consumer tests and demand to the state of the overall economy to government rules and regulations. It's varied. Companies again may not be able to completely avoid business risk. They can again take steps to mitigate its impact, including they can develop or strategize a risk plan to mitigate this type of risks. Companies which has higher amount of business risk may decide to adopt a capital structure, suppose with a lower debt ratio, to ensure that it can meet its financial obligations at any point of time or at all times. So, with a low debt ratio, when revenues drop, the company may not be able to service its debt, and this may ultimately lead the company to bankruptcy. On the other hand, when revenues increase, companies with low debt ratio basically will experience large profits and will be able to keep up with all its obligations. And next, we talk about financial risk. What is financial risk? It is a risk that a business will not be able to meet its debt repayment obligations, which in turn could mean that the potential investors will lose the money invested in the company. The more debt a firm has, the higher is its potential of financial risk. Basically, there are four types of financial risk. First is market risk. Market risk is largely caused by economic uncertainties, which may impact the performance of all companies and not just one company. Variations in the prices of assets, liabilities and derivatives are included in the sources of risk here. For example, this is a risk to which an importer company paying its supplies in dollars and then they are selling its final product in their local currency, and it is exposed In the event of devaluation, that company obviously is going to suffer losses that would prevent it from fulfilling its financial obligations. Secondly, in terms of financial risk, we can have the concept of credit risk, very important risk, credit risk. It refers to the possibility that a creditor will not receive a loan payment, or the creditor may receive that loan payment at a later date. Credit risk is therefore a way of determining a debtor's capacity to fulfill its payment obligations. In the context of credit risk also, there are two types of credit risk. One is a retail risk and the other is a wholesale risk. Retail risk involves in financing individuals and small businesses, whether through mortgages or to cards or any other form of credits like credit cards and so on. Wholesale credit, on the other hand, arises from the organization's own investments, whether in the form of sale of their financial assets or mergers or acquisitions of the companies. Now, the classic example of credit risk in recent times has been the subprime mortgage in the United States of America, which led to the economic crisis of 2008. And let me tell you that even after COVID-19, we still feel that the whole world is still reeling under the financial crisis of 2008. This explains why credit risk materializes when it is not managed properly. The subprime mortgages, what were the subprime mortgages in USA? They were high risk, high interest loans that were granted to people who were unemployed or did not have a stable income. Banks began to broad profile scope of subprime mortgage applicants in order to increase their income. However, since applicants could not pay, the delinquency of the debts increased. The third type of risk, financial risk, that we generally encounter is that of liquidity risk. Financial risk management must consider a company's liquidity, as every organization must ensure that it has sufficient cash flow to pay off its debts. Failing to do so may ruin the investor's confidence, and this is what basically we call the liquidity risk. And one of the possible causes thereof is basically, in the context of liquidity risk, it is poor cash flow management. That's a prime reason for liquidity risk. A company can have a significant amount of equity, but at the same time a high liquidity risk. That is because it cannot turn those assets into money to meet its short-term expenses. And the fourth one in this category is operational risk. These risks occur due to lack of internal controls within the company, technological failures, mismanagement, human error, or lack of employee training. Eventually, this risk, the operational risk, always leads to a financial loss for the company, always. And these risks can be avoided if a specific risk is considered to be able to trigger further risk. A broken down machine, for example, we know not only implies that we need expenses to repair it, but it also causes loss for production downtime, which can lead to a delay on product deliveries and even affect the reputation of the company. So, in conclusion, we can say that the types of financial risks are different for each company depending on the activities it carries out. However, it is essential to identify the potential risks and assess their impact, and accordingly draw out policies so that these type of risks can be mitigated. So, we see in the context of a financial system, in the context of a financial company or organization, we really need to understand these different types of risk, and we will also be understanding what are the different types of return, so that we can in totality analyze the context of financial assets or the security market.